In this presentation, we are looking at starting up a business and the tax considerations involved. There are three main types of businesses that we will look at in this presentation: a proprietorship, a partnership, and a corporation. In our textbook, these are explained as follows. A proprietorship is an unincorporated business owned by one individual. A partnership is the same as a proprietorship, except that it has two or more owners. A corporation is a legal entity created by a state. It is separate and distinct from its owners and managers. There are certainly advantages and disadvantages to each of these three types of businesses. The advantages of a proprietorship and a partnership are as follows. These companies are easier to form, there are fewer government regulations, and they are taxed like an individual, only once. The advantages for a corporation. The corporation can continue after the original owners no longer exist. Ownership interests can be divided into shares of stock. There is limited liability for the owners, meaning that the actual owners are not personally financially responsible for the business, and it is also easier to raise capital funds. The disadvantages. First, for proprietorship and partnership. There is unlimited personal liability. The owner or owners of this company are personally financially responsible for the business. Limited life. When the original owner or owners come out of this business, the business no longer exists. It will become a whole new proprietorship and partnership if it is sold. Difficulty in transference of ownership. The owner or owners need to search out and find their own buyers and then go through the legal process of selling and negotiate the actual costs of the sale. It is also difficult to obtain large amounts of funding. This is because the proprietorship or partnership is based upon the personal financial stability of the owner or owners, and there is no extra funding involved. A corporation and its disadvantages. It's time consuming filing the reports to the state and federal government in order to actually create and make happen the corporation. And corporations are double taxed due to dividend payouts per the government regulations. The question that we are looking at in our textbook is as follows. If you were starting a business, what tax considerations might cause you to prefer to set it up as a proprietorship or a partnership rather than as a corporation? And would you consider the average tax or the marginal tax rate to be more relevant when making the decision? We have to look at the biggest cause of looking at starting up a partnership or proprietorship versus a corporation, that the first are taxed once, the corporation double taxed. Taxes. Taxes affect investable cash flows and thus value. There are two types of taxes. There are tax laws applicable to individuals, and there are tax laws applicable to corporations. As stated in our text, the individual tax code applies to both individuals and families, and the corporate tax code applies to businesses that are organized as corporations. For businesses that are not corporations, the corporate tax code is not applicable. As a result, the taxes of proprietorships and partnerships are based on the individual tax code. Corporation versus small business taxes. In an article by Lawrence, I quote, "Corporations are taxed differently than other business structures. A corporation is the only type of business that must pay its own income taxes on profits. In contrast, partnerships, sole proprietorships, and limited liability companies are not taxed on business profits. Instead, the profits pass through the businesses to their owners, who report business income or losses on their personal tax returns." In this presentation, we're not looking at the LLCs, but this article did mention that. Corporate taxes. Let's look at how corporations are taxed. The taxes are progressive, just as individuals are taxed. The more the money you make, the higher the taxes go. Interest and dividend income received, as well as interest and dividend paid. Capital gains and losses, carry back and carry over, and depreciation. Let's look at some of these. Interest and dividend income received. This is defined as interest income received by a corporation, and it is taxed as ordinary income at regular tax rates. However, what our text states is 70% of this income is not taxed per the governmental regulation. So businesses are only being taxed on 30% of this. Interest and dividends paid. Firms use debt and equity to finance the operations. Debt can be in the form of such things as loans and bonds. Equity can be in the form of stocks. The interest paid to creditors, such as on loans and bonds, is tax deductible for the corporation. Dividends paid to the stockholders, however, are not tax deductible, and this is what we need to remember looking at a corporation. Capital gains and losses. This is defined as the profit or loss from the sale of a capital asset for more or less than its purchase. In our text, it states it has been argued that lower tax rates on capital gains, 1, stimulate the flow of venture capital, and 2, cause companies to retain and reinvest a high percentage of their earnings to provide their stockholders with lightly taxed capital gains as opposed to highly taxed dividend income. The rates certainly have fluctuated over the years, but the government has and continues to seem to take into consideration these tax rates. The government certainly wants to make their money in taxes, but in the same hand, want to make corporations successful so that people are buying into stocks and bonds and playing the money market. This helps our economy to continue to grow. Carry back and carry over. As quoted in our text, ordinary corporate operating losses can be carried back to each of the preceding 2 years and carried forward for the next 20 years to offset taxable income in those years. This enables the firms that have fluctuating incomes not to be penalized for their losses. So, not so much a loophole in the taxes, but it gives the corporations a chance to refile their taxes with an addendum and end up trying to make back some money and not having to pay those penalty costs in the future if they had a couple of years where they were not as successful as planned. Depreciation. Depreciation certainly affects the taxes paid and cash flows in a corporation. The government has specified the life which assets can be depreciated for tax purposes, and certainly any corporation will take this into account as well. Tax rates. There are 2 different kinds of tax rates that we look at, the average tax rate and the marginal tax rate. Average tax rate. The average tax rate equals the percentage of taxable income that is paid in taxes, whereas the marginal tax rate is defined as the percent of tax on the last unit of your income. With individuals and with corporations and other such smaller businesses as proprietorships and partnerships, one can look at the average tax rate or the marginal tax rate. In an article by Kennan, he quotes, "If you ask people about their tax rates, many people respond with their marginal tax rate, which is the highest tax bracket that they fall in for the year. However, because you don't pay that tax rate on all of your income, your overall or average tax rate is usually significantly lower. Your highest tax rate applies only to the higher levels of income." Kennan continues to state the marginal tax rate is most useful for determining how changes in your taxable income would alter your tax liability. For example, if you're in the middle of the 27th percent tax bracket, an additional $100 deduction would save you $27 in taxes. An extra $100 of taxable income would increase your tax liability by $27. You can use this information to make decisions about the true cost of making a charitable contribution or how much working will add to your income after taxes. So what we see here is that the marginal tax rate, as we discussed, is typically higher than the average tax rate. The marginal tax rate can help an individual or a business determine extra funds, how that will affect their taxes, extra debt and whatnot, or contributions that they're going to make. This helps them make decisions on how they want to further run their business in the financial world. Our answer or conclusion. There's certainly no right answer in these questions, as finances are definitely a game. There's no specific answer to work, and certainly the economy, the customers, and the environment all have effects on the business and their sustainability and financial strength. But what we do look at when deciding to open up what kind of business, a proprietorship or partnership, is the best to look at for taxes, as it is taxed only once. However, we do remember that in corporations there are governmental regulations such as deductions on taxes for dividends paid. With the question for marginal tax versus average tax. Average tax certainly is a good way to look at what you'll end up actually paying in taxes. However, again, let's remember that looking at your marginal tax rate will help you predict the future and what effects you will have if you lose money, gain money, get more debt, more equity, whatever you're looking at for your business. So again, no perfect answer, but these are just some of the conclusions I've come to in reading the text and other sources that I have gone through and looking at this question from our text. I hope you enjoyed the presentation. Here is a list of the references that I used. Thank you very much.